Greetings, everybody. Welcome to Liberty Call. Today is Friday, August 11th, 2023. Hope everybody's having a fantastical day out there in the interwebs. Another beautiful day here in Colorado. Got lots of sun, a few clouds. Got some yard work done earlier before it got too hot. But again, it's only 78 degrees according to my computer, so it's pretty nice outside today. So anyways, I'm glad you're here. If it's your first time watching Liberty Call, thank you very much. And please, if you could, give me some thumbs up, like, share, subscribes, follows, hit the notification so that you know when I go live. Not a good day in the markets, unfortunately. The Dow finished in the green, but I see a ton of red on the screen, and I think that's just kind of a personally, I expected this, but I think a lot of folks thought that when the Fed was coming to a close with their rate hiking cycle or near it, that the markets would turn more positive, but they have not. So, all right, let's go ahead and jump into the numbers for today. The Dow Jones was up 0.3%. Closed at, up 105 points, closed at 35,281. The S&P 500 was down or flat at down 0.09%, closed at 4464. Nasdaq down 0.56%, closed at 13,644. The VIX was down 6.37% today, which is kind of odd. It's currently holding at 1484. Canada was up 0.32, Brazil down 0.35, and Mexico down 1.19%. Over in Europe, Germany down 1.03%, UK down 1.24%, France down 1.26%, the Netherlands down 1.62%, Spain down 0.71%, Italy down 1.05%, Switzerland down 0.61%, and Portugal down 0.57%. Russian exchanges split today. The MOEX up 0.21%, the RTSI down 1.65%, and the overnights, the Nikkei in Japan was up 0.84%. Australia down 0.24%, New Zealand up 0.21%. In China, the Shanghai was down 2.01%, the Shenzhen Component down 2.18%, China 50 down 2.19%, DJ Shanghai down 2.14%, Hang Seng down 0.91%, and the Taiwan weighted down 1.4% for the day. All right, like I said, it was not a pretty day in the markets, but let's go ahead and take a look and see how the markets did for the week. All righty. Starting out with the Dow Jones. Looks like it's going to finish the week off up slightly at 0.42%. The S&P 500 is going to finish the week off down about 0.6%. Nasdaq, it's going to finish the week off down about 1.84%. The Dow Utilities up 0.65, and the Dow Transports down 0.97. So again, no, not fantastic, but to be expected. Let's zoom out and take a look at the Dow. And we can see again, kind of starting over here, the beginning of last year, we began this downtrend. And since then, in the fourth quarter, broke the downtrend, but have just been trading sideways for the better part of 6, 7, 8 months now. And if you zoom in a little bit, you can see where we're starting to build a downtrend here. It's a little easier to see on the S&P 500. It's a very similar chart. Downtrend last year started at the beginning of the year, broke through the trend in January. But again, really been trading sideways. Did have a little bit of an uplift here in the last couple months. But if we zoom in, we're starting to see a downward trend pattern. So we'll see if this continues to line up. And if it does, that does not bode well for the rest of the economy, unfortunately. All right. Let's go ahead and jump over to the economic data that came out this week, starting out with jobless claims. Initial claims came in at 248,000, forecast 230. Last week's number was 227. Continuing claims came in at 1.684 million. Forecast was 1.71 million. Last week's number was 1.692, so down by about 8,000. Those numbers still look pretty good. But again, keep in mind that your jobless numbers are going to be lagging indicators. They're actually going to still look pretty good when things are starting to fall apart. Your forward-looking indicators would be things like the yield curve and the shrinkage of the net worth year over year. I've covered that a lot with clients already this year. So if you're interested in seeing that data, give me a buzz. I'd be happy to talk about it with you. Next up, consumer price index year over year grew at 3.2%. The forecast was 3.3. Last month's number was a 3.0. Month over month, the CPI grew by 0.2%. So if we zoom in here and look at the only month where we've had a contraction in CPI was January. It was a contraction of 0.1. Since then, we have not had a contraction in CPI going back until June and May of 20. So, the inflation has, for basically all but 1 month going back over 3 years, has been positive. So, not great. The producer price index year over year grew at 0.8%. The forecast was 0.7. Last month's number was a 0.2. On a month over month basis, grew at 0.3%. Forecast was 0.2. And last month's number was flat at 0. So again, for producer prices, we can again zoom out. We had a few contractions, 1, 2, 3, 4, and 5. So, but really the only significant one was, let's see, we've had 0.5% contractions in April of this year and January, but the rest of them have been positive. And for the most part, they've been positive going back to probably those same months that we talked about. Yep. May, April, and March of 20. So, all right. Next up, consumer sentiment came in at 71.2. Forecast was 71. Last month's number was a 71.6. So consumer sentiment is still pretty high. So again, it could be much, much higher like it was during the, say, from 2015 to about 2019. But, it has been creeping up, which, again, is a little surprising. All right. So that was we didn't have a lot of data coming out this week other than small stuff. So let's go ahead and dive into the market recap. S&P 500, Nasdaq drop, big tech weighs after U.S. Producer price data. All righty, get my notes up here. On Friday, the S&P 500 and Nasdaq experienced declines, potentially marking another week of losses triggered by higher than expected U.S. producer prices data that raised Treasury yields and led to a drop in mega cap growth stocks, consequently weighing on these key indices. The U.S. PPI showed a 0.8% increase over the 12 months ending in July, a significant jump from the previous month's 0.2% rise, driven by rising service costs. Despite broad expectations that the Federal Reserve will maintain current credit conditions for the remainder of the year, the data caused a slight shift in the betting odds, with chances of no rate hike in September slipping from 90 to 88.5. Boy, that's a huge jump. David Russell, Vice President of Market Intelligence at TradeStation, noted that while the PPI data suggested lingering inflation concerns, investors were finding reassurance in other aspects of the consumer price index. Treasury yields responded to the data with the 2-year Treasury notes yield, which corresponds to near-term interest rate expectations, rising to 4.88%. This move negatively impacted prominent names like Tesla, Alphabet, and Microsoft, whose shares saw drops ranging from 0.4% to 1.1%. The semiconductor index saw a 3.2% fall, primarily driven by NVIDIA's decline, marking the 4th consecutive decline and 8th loss in 9 sessions for the index. If the index closes at its present level, it would record its most significant weekly loss since early April. Although mega-cap growth and technology stocks have previously led notable gains in the Nasdaq and S&P 500, the current trend indicated potential consecutive weeks of declines for these indices. Amid the sectors, healthcare and energy experienced gains, marking a shift in market dynamics. These sectors, which had previously performed poorly this year, showed an uptick, with the energy sector matching its best streak of closing higher for 7 straight sessions in 23. According to David Russell, this market movement signifies a healthy rotation, with investment shifting from large growth names to sectors that had previously lagged behind. In other market movements, News Corp shares rose by 4.4% following the media conglomerate's better than expected quarterly profit, attributed to cost-cutting measures. On the other hand, U.S. listed shares of Chinese companies Alibaba and JD.com saw declines of 3.9% and 6.1% respectively, after Beijing's recent stimulus measures failed to meet investor expectations. Additionally, fresh data indicated a slowdown in China's post-pandemic recovery. All right, so that's the recap for the markets today. So Got one last article. It has to do with unwinding all these, stimulus measures and everything that the central banks have been doing for the last couple of years to try and help us. We'll see if anything actually comes of it. So this article is titled "Beware the Great Unwind," written by Alistair MacLeod, and it, I think was originally published on goldmoney.com. This is a long article. I'm only going to cover my summary of that. So if you want to read it, it is linked in the show notes. So feel free to, it should be the last article listed. All right. Let me get my notes up and we'll dive into this. The article presents a comprehensive analysis of the potential trajectory of U.S. Treasury bond yields and its far-reaching implications for the global financial system. The central thesis is that U.S. Treasury bond yields are poised for a significant increase rather than stabilizing or declining, contrary to common belief. This would likely have cascading effects on interest rates worldwide. The author argues that the current fiat currency era is drawing to a close and the return to credit backed by real values, particularly gold, is inevitable. The collapse of unbanked credit is deemed to be imminent, given the monetary and currency distortions accumulated since the end of the Bretton Woods Agreement in 1971. The trigger for this collapse is predicted to be capital outflows from the dollar, creating a funding crisis for the U.S. government. The prediction is supported by the observation that the U.S. Treasury yields have entered a bull market pattern, rising above moving averages and showing signs of consolidating around higher levels. The consequences of rising yields are expected to be profound. The author highlights that the global banking system, which shifted its focus from financing Main Street to fueling asset booms on Wall Street, is vulnerable. The shift is now being unwound as interest rates increase, leading to credit tightening, potential counterparty failures, and reduced credit availability. The expanding derivatives market, largely denominated in dollars, is noted as particularly vulnerable. Furthermore, this article explores the potential shift away from the dollar as the world's reserve currency. Russia and China are cited as leading this movement, particularly through the Shanghai Cooperation Organization, the SCO, and the BRICS group, Brazil, Russia, India, China, South Africa, with plans to settle trade in currencies backed by gold. This shift is expected to undermine the credibility of fiat currencies, especially the dollar. And I can't blame them. The way that the U.S. has treated the world, I'm shocked the rest of these countries that we've been beaten up the last 100 years, basically, haven't all banded together and nuked Washington. I'm shocked, personally. I mean, that's what I would have done. All right. This article argues that the traditional understanding that rising interest rates are negative for gold is flawed. Instead, the author contends that rising rates reflect market assessments of the future value of a currency, considering both time preference and counterparty risk. Since gold retains its purchasing power, its value is less influenced by these factors. The author suggests that the relationship between gold and fiat currencies could be reshaped by the forthcoming changes in the global financial landscape. In conclusion, this article posits that the prevailing narrative is stable or decreasing bond yields is misleading. It forecasts a significant increase in yields with far-reaching implications for the global financial system, the dollar's dominance, and the value of gold. While some of the predictions are speculative and contingent on geopolitical developments, the article provides a thought-provoking analysis of potential trends in the financial world. In scene. All right, some good stuff there. So, like I said, it's a pretty long read, so I would recommend doing that when you have some time to kill. So, all right, well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful weekend, and I'll talk to you next time. Adios.